Greetings, everyone. There's a crash coming in the data center market. I want to give you a little bit of an overview. Over the past couple of days, we've seen a couple of very interesting, world-changing, life-shattering perspectives happen and decisions being made, specifically by Elon Musk. First of all, we saw the merger of XAI into SpaceX, creating a $1.2 trillion company. Now, this is also the organization that has the space-to-Earth satellite network that has offered high-speed internet all over the world in crisis. So he knows that the steps that need to be taken to reduce the latency issue. But now he's changed the whole real estate business once and for all. Many of us have been investing in data centers for a long time. We have not been developing data centers, but we have some other investments in that space. But if you have a data center investment, I want you to pause making more investments right now, because you have a couple of different things that have happened. Just to give you a little bit of a basis, I'm looking very often for 50, 100, 200 acre parcels in these major Texas cities anyway, to develop pre-agenic, robotic, future-proof locations that are not quite data centers, but they have heavy power, heavy infrastructure, and heavy access as well. But we can't find as many as we want. Why? Because these data centers are buying them up. These hyperscaler developers are buying them up in spades. And so the ones that are left have low energy access, low water access, and high regulatory burdens to be able to develop those. And so what do we do? Well, many companies are looking out into farmland. You look at what's happening in Vermont. You look at what's happening outside of the DC metro area with these hyperscalers there. They're looking out further away from the population centers to be able to develop. It creates a few different issues. Number one, with utility infrastructure. Number two, you need a large quantity of electricians to support this. For example, a 1 million square foot data center, maybe as many as 400 electricians to work on the different components, to work on the power production, which you would inevitably need on site for most of these situations. And it creates a big burden there, which you don't have school systems out in the farmlands. You don't have things for the wives to do, things for the spouses to do. And so it creates a really huge burden when they try to move these data centers out, further out. What Elon has done, he's come and said, okay, energy is one of the main drivers. It's a perpetual tax on geographically based data centers. He said, well, what if we take these data centers and we pull them out of the geography, put them into the orbit? We pull the data centers out of the geographic domain and put them into the orbital domain. What can happen then? Well, number one, you give them continuous solar exposure. Continuous solar exposure, 24 hours a day. It's pure. It doesn't have to enter the atmosphere. It doesn't have to worry about maintenance. It doesn't have to worry about anything else that can impact that power flow. The continuous sun exposure gives continuous energy. And it's a capital cost to build out the solar panels, but it's not an operating cost. And anytime you can convert capital costs to save an operating cost or to heavily reduce the operating cost, that is generally a win. Now, what this does in immediacy is it helps the orbital data centers that Elon wants to build. It helps them outcompete from an OpEx standpoint the geographic data centers that are here on Earth. But you still have to deal with the transport of the data center, the building of the data center, and so forth. But then you bring on this second advantage. The second overwhelming advantage is that your cooling costs in space approach zero. In Earth, you have to worry about all of this cooling, all of this water, all this energy flow, all these redundancies. But space provides radiative cooling without water, without chillers, without any evaporative systems. That's a massive advantage. That's a lot of infrastructure. So if you can take care of the engineering and the transportation to get these data centers into space, your energy and your infrastructure costs there are probably 90 to 95% less than what they would be in Earth. He's converted an operating expense into a one-time capital expense. Now, he's already begun to figure out the issue with latency, that training and inference can happen close to satellites and using global data systems in space. But the training that happens doesn't have to be so reliant on latency. It's the the training GPUs are not the ones that are used to serve us. It is the immediate operating and interface collection and procedures and processing that serves us. And so those are the ones you have to worry about latency. The weakness that you pay for a location premium is that you have to be close to redundant fiber. And the best place in the country to get redundant fiber is just outside of DC. And that's where all the hyperscalers are. But if you're in space, you have built-in redundancy because there's nothing really in the way. Your redundancy is not built at the supply, but it's redundancy built into the outlet. So you can have one satellite that could provide internet access from a number of locations on the Earth to be able to get to that one satellite, instead of providing multiple fiber routes into that data center into multiple locations. You see, it's less engineering for greater redundancy. And if Elon, like he's asked for a permit for up to 1 million satellites, well, that's going to be an incredible advantage, 1 million points of potential redundancy. And so once compute is no longer tied to land, power utilities, and water rights, the scarcity thesis collapses. And this is what all the data center developers are based on, is this scarcity thesis, that there's not enough land, there's not enough power, there's not enough AI compute in the world. We have to answer this. Why are the big AI companies not putting the data centers on their own books? Why aren't they buying? They have plenty of cash, they have plenty of credit. Why aren't they putting the data centers on their own books? Well, that tells you these are temporary needs. These are temporary needs. And my expectation is that these AI companies are going to default on these leases at some point, leaving data center developers holding the bag. And this is why we're going down market to look at pre-agentic robotic infrastructure, these warehousing and industrial facilities that are close into the major Texas urban areas with heavy power, heavy infrastructure, and able to handle a little bit of compute, but also able to handle the robotic capacity that's going to be needed, along with the electric trucks and the recharging stations needed for that. These fully autonomous logistics and warehousing facilities are really going to be the way to go. This is where they're going to get a lot of the efficiency. This is where they're going to shave a lot of the jobs. And this is also where we're going to find a great place to be coming forward, because unless you can get rid of the physical world, you're going to need a physical distribution system. And that's where these pre-agentic robotic high automation facilities close to the great high growth urban centers in Texas, that's where it's going to be needed. And so that's why I'm switching out of data center investing and switching into a different type of asset type. So I encourage you guys, if you think about it, reconsider the data center investing. That looks like a fool's game at this point, especially with Elon's announcement over the last few days. So cooling costs are approaching zero for in-space data centers. They're only accelerating for geographical on-land data centers. Energy, which becomes a scarce resource right now for developers, is now an abundant resource in orbit. And latency becomes orbital, not geographic in nature. And so just a few insights there on the data center crash that I see coming, not in 2026, probably in 2027 to 2029 there. But we do believe internally that we'll reach AGI before 2030. And at that time, it will be impactful in a way that we can only imagine in our dreams how few pieces of technology we're going to need. So many of you have asked me, why don't the AI companies want to own their own data centers? Why don't they want to own their data centers? That's a great question. I think there's a crash coming. I still believe there's a crash coming. And if you have capital in data center developers especially, I would certainly caution you against keeping it there. So what do the AI companies know that the developers don't know? What do the AI companies know that the developers don't know? Well, the AI companies have massive balance sheets. They have massive credit facilities. They can easily finance these. They can even buy the developers that are developing these data centers, but they don't want to because they know the GPUs are obsolete much sooner than the data centers will be obsolete. Compute assets depreciate faster than buildings. Buildings typically 30, 40, 50 year lifespan. GPUs have a 24 to 36 month lifespan. So why would you invest in something that depreciates over 30 and 40 years, but it only has a 2 to 3 year life cycle? It doesn't make any sense. And then additionally, after 24 and 36 months, as you replace these GPUs, these AI companies replace the GPUs, the efficiency kicks in, so the models get more efficient every generation. The AI firms don't want to use their capital and strand their capital in these 20 and 30 and 40 year investments in the concrete. And still, they need to be able to move. They need the switching flexibility to be able to move into other areas. Additionally, the training isn't straight line. It's not a straight line AI training to be able to generate these LLMs and to generate these models. It's very, very lumpy. It's very, very lumpy. And so the developers are underwriting for total utilization of these facilities. But the AI companies, they know that the lumpiness means that the demand is shrinking. The demand is shrinking. It might poke out a little bit, might increase a little bit over time, but generally it's shrinking and it's lumpy. And so the developers are underwriting for something that's not there, for demand that's not there. Thirdly, model efficiency is proven faster than the square footage demand. And so if you think about it, assume that the developers are developing an additional 20% square footage of data centers every single year, so 20% more every year. But the efficiency of the modeling is increasing 30% a year. So after 3 years, you get 60% more square footage, assuming they're able to develop that, which they're not able to develop that fast, but 60% more square footage, but 90% more efficiency, which means that the 60% more square footage is no longer needed because there's 90% additional capacity there. So not only has the inventory, the square footage inventory not grown by 60% like you develop, but also the existing inventory that you had at the beginning of that 3 years has decreased by 30%. The need is decreased, but yet the developers are still underwriting for, always on occupancy, fully necessary occupancy, full engagement. The AI firms really want optionality. They really want optionality with their cash because they don't know what's going to happen in the future. And so this infrastructure acts as a drag, right? If you have a traditional warehouse, you can always move the tenant out and you can bring in new tenants. There's always going to be a need for physical goods. But this is not a physical business. The chipsets and the infrastructure inside these buildings is not a physical asset. It's an electronic asset. The assets are in atoms, or in electrons, not in atoms. And so we have to figure out, why is this happening? But leasing the compute, as the AI centers are doing, as AI companies are doing, it helps you keep the thing off your balance sheet and preserves capital for R&D and acquisitions, and also for maneuverability strategically for other investments. And so I see that these AI companies keeping these data centers off their books tells me that when the users of the facilities say that ownership is poison, maybe the assets themselves are really poison. Maybe that's an opportunity to take a step back, take some chips off the table, and move back into other asset types that have more longevity and that are better positioned. I suspect you'll be able to buy data centers for pennies on the dollar a decade from now. And for assets that depreciate over 20, 30, 40 years, that's not a good thing. When the usability depreciates every 24 to 36 months from the growth of the chipsets and the GPUs inside, and the efficiency of the algorithms and the software itself gets 30 and 50 and even 100% better every 12 months, that's not a good situation to be in, especially as you're constructing new square footage and putting that on the market. So this is just another reason why we believe data center market is going to be crashing over the coming years. It's a great time to take some money off the table and move into other asset types. I wanted to look a little bit at the signs that you know that you're in a crash. Because a crash isn't going to be dramatic. It's going to be silent. It's going to be silent. And it'll happen behind the scenes before you see it happening in front of you. You look at the big quasi-crash of multifamily of a few years ago where you saw cap rates trading at 3.5%, 4%, and today they're up at 5 and 6 and even 7% in some markets. We know that there are certain signs that happen in advance. And so one of those signs is that lease renewals are happening, but they're happening at lower rates. They're happening at lower rates than anticipated. You can't always get that 3 to 5% bump every year. You cannot always get that CPI inflationary bump every year. The bumps happen at the renewals, and sometimes there's midterm lease renewals that happen, but oftentimes there's a lack of need and even a walkout risk for different tenants. And so, for instance, if the AI companies are developing new technology and replacing the GPUs every 24 to 36 months over a 20, 34 year life cycle of that asset, it would be highly probable that they'll need fewer square feet to produce the exact same output of these more efficient iterations of GPUs, because every 24 to 36 months, the facility gets 30, 80, 100, 200% more effective on the hardware side. Now, that's also in addition, that's not even including in addition the advancements that happen on the technology side, on the software side that may be 100% per year more efficient. So if you think about your data center production is generating 100% the first year, but maybe it's generating 200% the second year and 300% the third year. Then you're coming in for a GPU swap out, and the data center owner is thinking, well, I've got another 18 years or 17 years left on this lease. The AI company is looking at this and thinking, well, we could either replace all these GPUs or we could take this one of 100 data centers and just close it down, because all the other data centers are also 300% more productive, right? If it's 300% more productive and the demand is the same, assuming it is, you're going to need a third of the space. You need a third of the space, and this is what's going to happen, we believe, very, very quickly in the next 3 to 5 years with data centers. Secondly, capital calls. You're going to see with investors, especially large institutional investors, are going to see that the capital calls don't pencil for data centers. Data center developers are going to see that they're not able to renew these AI company leases at the rates that they wish. Back to might have defaults that happen, and they're going to have to engage in cash calls with their investors. The cash calls aren't going to work. They're not going to pencil. And so the more sophisticated investors are not going to meet the cash calls. And then thirdly, you're going to see as a preliminary sign, before you know that there's a crash coming, the lenders coming in and seeing these refinances, these cash out refinances, which most developers will account for unless they're going all cash. They will not be able to refinance as quickly as they want to, and the cash out will not be what they want. Additionally, additional personal guarantees will be seen to be required from the smaller developers, and this will be more cautionary in nature, and you'll see less demand, less desire for these cash out refinances that investors have become so addicted to over the last 20 years. Then finally, what you'll be able to see before you know there's a crash coming on is that you'll be able to see that these assets that work operationally, but they fail financially. They work operationally, they fail financially. A data center developer or a REIT might say that we have 90% occupancy or 98% occupancy portfolio-wide, and you're thinking everything's fine. But what you don't know is that the tenants are all renegotiating because they're all being given the new advanced versions of the GPUs. They're all being given the new types of formats of training materials. They're all in the same curve, this lumpiness of the training algorithms that occur, and they'll all be at a down point. And so they'll be able to negotiate and have immense bargaining power with these developers, especially the REITs. And so these are the things that are going to be happening in the background before you know a crash is coming. When you start hearing rumors of these, expect and prepare for a crash. Lease renewals at lower rates, capital calls that don't pencil, refinancing gaps, and assets that work operationally but fail financially. And just like the multifamily bungle that happened a few years ago, you'll see cap rates being compressed. And whenever the cap rates begin to expand again, it will more than likely be a little bit too late. It'll be a little bit too late because the multiplication on those cap rates on the NOI will be such a tragic loss of invested capital. The investments may be worthless by that point. A slight tick up from a 3 cap to a 4 cap is a 33% loss in value, 33% cash into the deal, and the rest debt. You've lost the entirety of your investment. So that's a difficult place to be. But these are the signs to be looking for as you suspect a crash is happening. Hopefully that helps.